Time once again to check on the latest earnings trends with Zacks Director of Equity Research, Dirk Van Dyke. So here we sit now on the 10th of February, and by the end of this week, about 3/4 of the S&P companies will have reported. They are poised, it looks to me, you correct me if I'm wrong, to post their first aggregate net quarterly loss in a while.
Well, no, actually the numbers that we have are showing about a 33% decline on year-over-year profits from pretty low levels a year ago.
Okay.
And then looking forward to the first quarter, again, this is combining those that have reported and those yet to report. We're looking about another 29% year-over-year decline. Now, this excludes extraordinary items, and there have been a lot of extraordinary items, and very few of those have been, extraordinary gains.
Well, the figure I'm seeing is that the Street is looking for a fourth quarter S&P negative growth rate of 40%.
Oh, well, yeah, growth rate, but that's not.
That's what I was leading up to.
That's not red ink. That's and right now, again, on the excluding the extraordinary items, our numbers are showing a 33% decline on a year-over-year basis. So that's still, it's a lower amount of black ink, not red ink.
We're showing in about 10 years?
Oh yeah, I don't have the exact figures going back that right there with me, but there may have been one or two quarters during the last recession that might have come close, and beyond that, I mean, you would probably have to stretch back a few decades.
Okay. Of the 10 S&P sectors which are reporting year-over-year quarterly earnings growth, which are reporting quarterly earnings growth, there's not many of them, right?
They're really right now, again, for what has been reported so far, and if you throw in the expectations, there are only two: healthcare and electric utilities. Electric utilities have been helped by the fall in energy prices, which lowers their feedstock costs more than electric rates have come down. That's probably a short-term phenomenon, because the public utility commissions are going to say, hey, we put in all these rate increases for you when prices, energy prices were going through the roof. You're going to have to give some of them back. The other is healthcare, which is a classic economically insensitive part of the economy. And then, the consumer staples sector is, showing pretty moderate, low single-digit year-over-year declines. So, that's the one that isn't, a major disaster. The big disasters are the financials, the materials, the consumer discretionary, all of which are amongst the ones reporting so far, are all down about 80% or more year-over-year. So that's a disaster.
What's the beat rate? Percentage of companies posting better than expected earnings?
The surprise ratio, number of positive surprises divided by disappointments, is about 1.7. So there are more positive surprises than disappointments. But the pattern that we had seen over and over and over again for the previous 5 years or so, not so much in the third quarter, but part of it was a normal ratio was over 3.
So are those solid beat numbers, or are those beat numbers because of extraordinary events, because of accounting anomalies, or whatever?
I think it's from the executives and the IR people sort of talking down expectations as much as they can prior to, sort of under-promise and then over-deliver type thing. Again, we try and strip out the extraordinary items, so not that much is just from the extraordinary items.
So give me a bottom line number for Q4.
In Q4, again, probably down between 30 and 35% year over year.
Okay. What are you seeing for beginning part of '09 here, after we catch our breath from this season?
We're probably going to be, again, down at least 30% on a year over year basis. And you got to remember also
For Q1?
For Q1.
Okay.
For all of the S&P 500 for all of '09, right now the estimates are for -10. I think it's going to be a lot worse than that. The momentum of the estimates is going down. If you want to translate that into an earnings per share for the S&P 500, right now it stands at about $66, but that's down over 2% in just a week. And if you were to cut that rate of decline in half to 1% per week, that would translate to an earnings per share of just $41 for the S&P 500. Now, that might be a little bit extreme.
Not a good picture.
But certainly I think at this point, less than 55 looks, pretty much assured. And then one has to say, all right, what kind of multiple do you put on, $50 to $55 worth of earnings?
And we'll get that question answered once we begin the 1Q reporting season. I have to leave it right there. If you want to see Dirk's text version of his latest earnings commentary, it's chock full of all of the tables and numbers that we kind of overview here for you in this video. Then go to Zacks.com, scroll down the homepage, click to the headline or on the headline next to Dirk's picture, and it'll take you right to it. With Dirk Van Dyke, I'm Terry Ruffalo.